Debt Lesson 2, Credit Card Debt. In this lesson, you're going to learn about the debt trap that people fall into by misusing credit cards.
You already learned how to build credit without going into debt in the credit module. We're talking about it again because using credit cards the wrong way is such a massive problem in our society.
Credit cards are great if you have a plan and self-control to stick to that plan. However, credit cards can encourage a lack of self-control. Having the ability to be able to buy nice things, even when you can't afford them, can almost be irresistible for some people.
And some people turn to credit cards to help pay for emergencies that they can't afford, like medical bills, car repairs, or losing a job.
It's very expensive to use a credit card the wrong way. Rising inflation rates are making everything more expensive. Credit card balances are going up at a record pace because people are using their credit cards to help them pay for their bills. They can't keep up with the rising cost of housing, and the cost of goods and services are all becoming more expensive as well. We live in a society where we're used to having instant gratification. We have access to almost anything we want at our fingertips, from online shopping to Uber Eats to even having your groceries delivered. All it takes to spend some money is a couple swipes or taps of your finger. Spending more than you have for instant gratification is easier than ever.
Studies have shown that people are more likely to buy products at a higher price point, give bigger tips when they go out to dinner, and buy more things impulsively when they use a credit card.
When you hand over cash as a payment for something, it's tangible. You can physically see that you have less of it after you pay for something. People tend to view cash as real money, and they form more of an emotional attachment to whatever it is that you buy with cash. Swiping a credit card for money you don't have doesn't have the same psychological response in your brain. According to a study the Federal Reserve did back in 2016, the average transaction was only $22 when people paid with cash, compared to the average transaction of $112 with a credit card. That's a 409% difference.
If you rack up a balance on your credit card, it can be tempting to not pay the balance in full. Making just the minimum payment, which is usually around 1 to 3% of your outstanding balance plus interest, feels a lot easier than repaying everything you borrowed all at once. And that's exactly where people mess up. If you're overspending and using your credit card to afford a lifestyle that your income can't support, then every month you dig yourself deeper and deeper in debt. By making just the minimum payment, you're keeping your head above water by making your payments on time, but those minimum payments aren't helping you. Now you have an additional credit card bill to pay every month on top of all your other bills, and the more bills you have, the more stressful life becomes. If you're like most Americans and living paycheck to paycheck once you grow up, adding an additional credit card payment can feel overwhelming. The payments for debt that you can't afford usually eats away at the little bit of extra money that you might have had for doing stuff that you enjoy, like going out with friends or traveling or whatever hobbies you might have. If you find yourself only making the minimum payments, repaying the money you borrowed is going to feel like it takes forever to pay it back.
For example, let's say that you had a credit card with a balance of $2,000 with a 22% interest rate. You're only able to make the minimum payment, which is 1% of your balance plus interest. That's roughly $56 a month. That sure is a lot easier than repaying that full $2,000 that you owe, which is why so many people fall into this trap. But here's the catch. If you're just making those minimum payments, it's going to take you 4 years and 10 months to pay off that balance. Plus, you would have paid $1,200 in interest for the $2,000 that you had borrowed. If you're able to pay $150 a month, it would take you only a year and 4 months to repay your debt, and you'd only be paying $314 in interest. That's a huge difference, which sounds great. But that's only doable if you can afford to pay that extra $100 a month on top of the minimum payment.
The problem is that most people can't afford to make the additional payment on top of the minimum payment. That's how you can get trapped in the debt cycle. Throw in paying for student loans, a car loan, rent, food, gas, and everything else you might have to pay for, and you can see why so many people end up living paycheck to paycheck. Inflation is growing faster than it has in 40 years. Food's more expensive, gas is the most expensive it's ever been, the cost of housing is sky high, And the price of new and used vehicles is surging. Credit card rates are also going up because the Federal Reserve is trying to fight inflation. They fight inflation by raising the interest rates when you borrow money. Interest rates on credit cards have a variable APR, which means that the credit card's interest rates are going to go up when the Federal Reserve raises the overall interest rates. What that means for you is that it's going to be more expensive to borrow money if you don't pay your credit card in full every month, which is just another reason to not fall into creating bad habits with using credit cards.
Most people rely on credit cards for emergencies because they don't have an emergency fund. Please, please, please don't ever fall into this trap. If you follow the advice that we gave you back in banking lesson 5 about emergency funds, you should ideally have at least 3 months worth of expenses saved up before you move out. Yes, that is a lot of money on top of everything else that you need to pay for to move out, like a security deposit, first and last month's rent, plus all of the other stuff that you have to buy. But having an emergency fund to fall back on instead of a credit card will save you huge amounts of stress and financial hardships as an adult.
Life has a way of kicking you in the teeth financially when you least expect it. Your car could break down, you might have to take your pet to the vet for an expensive surgery just to keep it alive, or you get your hours cut at work, or even worse, you lose your job. Having that emergency fund helps you get by and cover those bills until your financial situation improves. If you use a credit card to float you through those hard times, it will most likely create more hard times by making it harder for you to afford future credit card payments every month going forward.
You just learned about the dangers of going into debt with credit cards. If you use your credit cards the wrong way and you carry a balance, falling into the debt trap can make your life significantly harder than it needs to be. Impulse buying online with a credit card might be easier than ever, but repaying the debt isn't. That's why it's so important to only use your credit card for small purchases that's automatically paid off each month. If you do that, then none of these bad scenarios will affect you.
In the next lesson, you'll learn why avoiding auto loan debt is so important to being able to financially survive as a young adult.